Is inflation cooling or heating up? What if the actual inflation rate was twice as high as the official numbers suggest? In this video, we'll break down the latest durable goods orders, core metrics, and their annualized trends, plus retail sales in both nominal and real terms, PPI breakdown, and a chart that predicts inflation like clockwork. So, what if the actual inflation rate is actually twice as high as the official numbers suggest? We will get to this at the end, but first, real quick, core durable goods and durable goods orders came in both higher than expected at 0.1 and 0.5% respectively. Here's a way to approximate the year over year growth rate annualized out. For whatever reason, they don't report that, so you have to multiply by 12, then put a 12-month moving average on. Right now, you get durable goods running at about 10.2% annual growth rate. This is quite strong compared to kind of historical average of the post 2008 sort of world. And you have core durable goods ex defense running at about 8.8%. And of course, moving on here to retail sales, this is a nominal figure. So remember, if inflation is, say, 10%, prices are going up 10% per year, well, the amount of retail sales is going to go up likely somewhere around 10%. So you have to adjust these nominal figures, which might sound really good. 4.3%, that is near the upper end of the range of the post 2008 sort of landscape. But once you adjust for inflation, it's actually near the lower end of the range in the post 2008 sort of world. So this is one example, one of many examples of how the nominal figure can be misleading. So, nominal figure, whether it be the average hourly wage, nominal retail sales, all these numbers that you hear reported by the mainstream media or your nightly news, they are generally not looked at through the right lens. So, once you look at it through the right lens, you can see that real retail sales growth is actually only running at 1.3%. And as you can see, from about April of 2022 all the way up until recently, September of last year, October of last year, this was actually negative. It was running at negative real growth rate, meaning that real retail sales, once adjusting for inflation, was actually going down, despite the fact that if you look in nominal terms, it was quite strong, 4, 5, 6%. So one of many examples, one of many reasons that you need to look at things through the right lens, which is, of course, what we try to do for you here. Producer price index. Now, it's important to remember that consumers do not feel inflation as a year-over-year rate of change. That is the way that economists look at inflation, or market participants look at inflation, is the year-over-year rate of change. But consumers or producers generally feel inflation through a cumulative rise in prices, which is what we're looking at in orange. Remember, whether it's PPI, which is the current look at inflation that we're going to look at here, or CPI, those are both looking at an actual index. So consumer price index, producer price index. The number you hear reported by the media is actually the year-over-year rate of change of that index. But as we can see, prices always go up into the right, generally speaking, outside of a recession. Prices, whether it be the CPI index or the PPI index, they are going up and to the right, kind of in perpetuity outside of recessions. This is one of the kind of conundrums the current administration finds themselves in. Americans are very, very unhappy and very, very upset over the cumulative rise in prices. But generally, the only way that you actually get those price levels to come down is by an economic contraction, by a recession. And by definition, the economy is contracting, people are losing jobs. So we're in a very tough spot here because consumers really are struggling, as we went over with the recent Mike Green article, the new poverty line being about $150,000, $160,000. Consumers' inflation has just absolutely brutalized the average American. And the only way to get that price level, the orange line, to come down, the actual price level, is through a recession or an economic contraction. By the way, producer price index year over year running at 2.7%, core PPI running at about 2.6%. By the way, both of those are closer to 3 than they are to 2, which is the Fed's long run inflation target. Now, here's that predictor of inflation. So here we're looking at ISM PM PMI, Purchasing Manager Index, the manufacturing survey. Now, within that survey, there are individual sectors or components. One of the things that they survey are prices. So if you take that manufacturing prices from the PMI report and you push it forward by 3 months, you can see there's a pretty good predictor of where PPI is going to go. Now, why this is important is that PPI in and of itself is a leading indicator for where CPI, Consumer Price Index, is going to go. Producers feel the pain first. That is reported in the monthly ISM PMI. Then it gets reflected in and measured by the PPI index. And then it gets passed on to consumers. So there's a couple lags there. So the first one being ISM PMI manufacturing. Then you get PPI reflecting the price change that ISM PMIs was showing. And then finally, about 4, 5, 6 months later, you get consumer price index reflecting what producer price index was a couple months prior. So it can be helpful for trying to forecast where inflation is going. And by the way, as we can see, this has been trending up and to the right, going all the way back to early 2023. So the actual inflation rate. So what better way to measure inflation than by taking personal consumption expenditure? This is that PCE index, which is actually what the Fed uses. Their preferred inflation gauge is PCE. So here we're taking personal consumption expenditures and we're dividing it by the labor force. So what we get is how many dollars per year is the average person in the labor force spending. Right now is about $123,000 per year per person in the labor force. Now, just for comparison, here in January 2020, it was only about 90,000. So that's a pretty notable change from going into, of course, all the events, all the money printing of 2020. You can see that since January of 2020, this measure, this direct way of measuring inflation is up 38%. Now, if you look at CPI, it's going to tell you something in the low 20s in terms of the inflation rate cumulative over the past 5 years or so. However, if you look directly at what consumers are spending per capita, that is up by 38%. So arguably, this is a much more direct way of measuring inflation. You're looking at what consumers are actually spending. Now, by the way, PPI all commodities index, of course, commodities being an input for everything, you can see the kind of notable step change in the past 5 years when it comes to input prices. So what we're going to do here is we're going to take the annual rate of change of this personal consumption expenditure per capita. Again, it was about 90,000 in January 2020. It is now 123,000. What we're going to do is what inflation metrics generally do with CPI index or PPI index. We're going to take an annual rate of change of the underlying metric, which is PCE per capita. So once we do that, what we get is PCE per capita running at 3.2% current annual growth rate. However, if you look at the 5-year moving average of this direct measure of inflation, 5.9%. So basically 6%, which is double what the official inflation metric would suggest. Now, it's important to make this caveat. This does not adjust for volume. So if consumers are spending more, but they're getting more in terms of volume of goods and services, then this is going to slightly overstate actual inflation. But I think that we are probably much closer to 6% or 3.2% right now than we are to what CPI would indicate, which is 3%. Yes, this does not adjust for volume, but I think that if, this is arguably a much more accurate way because you're looking directly at what personal consumption expenditures per person actually are. They went from 90,000 per year per person to 123,000. That is about a 40% increase in the past 5 years. So anyways, hopefully that was helpful, and I will catch you on the next one.